Let's go take a look at what we have on the books today. All right, so as we usually do, want to start out with taking a look around the world. This European market wrap is a really good summary of what's going on. Of course, Europe is still open right now, but if you scroll back, you can look at the Asian market wrap as well. This is often useful for identifying what sectors were hot, what were not, maybe what took us to the upside or what took us to the downside. Also, in this same spot, using Finance Juice, you can usually see if there's going to be any speakers. They'll be listed here along the side. We've got a lot of econ today, but I don't see any speakers, which we've had a lot this week. Different events going on in different locations around the world. But if there was anybody scheduled to talk, this is normally where you would find it. Keep in mind, even if you don't see somebody on there, that doesn't mean that they can't pop up onto the news services. Right, we've seen that back in May 20, I believe, when one of the Fed speakers just popped up on the news networks and started talking. Eight 8:30, 9:45, 10:30, 11, 11:30, and then 3 o'clock. All right, so that's the box for the weekly expected move. And as you can see, while we held range yesterday and managed to close the day inside the box, once we opened up into Globex and began that move, we are now outside of the box. Statistically, we stay in that box at least 70% of the time. And for the S&P, it's actually more like 80% of the time. Having said that, during the option Omega back testing that we were doing on Tuesday, we counted back the last 10 weeks. And in the last 10 weeks, we've only closed in the box 30% of the time. So, of course, it's directly connected with volatility. And I've said before, when this thing starts to break outside more often than it doesn't, it's actually a precursor or a warning for more danger to come. If you go back and look to the pre-COVID crash, say December and into January, you'll notice that the S&P was breaking out of this box a lot back then too, right before that massive sell-off. It's not a predictor tool. This thing is just demonstrating what our range is, a one standard deviation move, and then we're gauging what the market did do, right? So on one side, it's forward looking and says this is how far we should move in a week. And then at the end of that week, we look back and say, did we move that much or more than that much? Statistically, implied volatility overstates the move way more than it doesn't. So if it says we're supposed to move, say, $100 in a week, it's overstating the move, usually by a good 10 to 15%. If it says we should move 100, what we usually end up with is like a 80 to 85. And so you can usually use that. That's where our edge comes from. Now it's understating drastically. It's pointing out, say, that we may move $100 and we're actually getting 120 or 150, right? So that's the situation that we're in right now. I misspoke the other day too. I did mention that this Friday I was going to be putting on one of the new mechanical iron condors because we worked out the kinks of being able to use it in this new environment. But this is a holiday week. Next week, we're going to have 4th of July on Monday. I don't put on mechanical systems on short weeks. So I misspoke. I won't be putting one on Friday because next week is a short week. All right, that white line right there is a linear regression line. Think of it like the center of the basketball court or the football field. Take your pick, right? Pick your sport. It it often helps us visualize where the swing high and the swing low is. When you use a linear regression line, every candle matters, right? It's that's the way it's designed. It counts every one of those candles, and the word is like instance, right? So how many instances are there? And then it formulates its math. So when you go to use a linear regression line, be consistent in how you use it. If you're going to use it on a daily chart, how many days are showing are really important. Just because you went to a daily chart with it doesn't matter. It's how many days. So a 1 year daily will not look like this. It won't be in this position on the linear line. You know, it will present entirely differently. So just because you're on a daily and I'm on a daily doesn't mean we're going to get the same outcome. How many candles you use are really important. This chart is set to year to date. And so every day when we get a new candle, it just adds to the narrative, so to speak. I don't change it. I always look at this on a year to date. That's the idea behind it. Find some consistency in how you use it. So when we came off of that bottom in the earlier part of June, we had a nice little basing pattern, a reasonably decent leg up, but the leg up didn't even last 3 days, and we're already rolling back over and heading down. If you notice the last leg up, we had a tight consolidation package well over a week before we broke down, set a new low, and then consolidated down at those levels. Then we had the break up, a very small amount of consolidation, and now the next breakdown. At the very least, the downside target is going to be back to the previous low. Common sense, right? That we would at least go that far because there's nothing that says that we're done with this market route, that we're coming up off of the lows. There's nothing out there that says that the Fed has accomplished their goals. We haven't come close to max pain either, and there's been no uh, bottoming signals that we would use. So even with that consolidation yesterday, there was an idea that we could perhaps make another leg up because we are due eventually for a bear market rally, some kind of strong 2 week, 3 week, 4 week rally in one direction. Historically speaking, we're due for one. Doesn't look like we're going to get it yet. So what we got today is an inside day breakout. Captain Obvious, right? We are below yesterday's level. What we want to be watching for and what we want to game out is the three scenarios. We could maintain outside of the box, holding at our current level without really expanding much more to the downside. That would be our range base case. That we would just hold this level. I find that one the least easiest to believe, right? The least likely scenario, I guess is a better way to say it. But that is one scenario that we just base right here for the rest of the day. Argument number two would be that we run back up and get back inside of yesterday's price action. Now, yesterday's price action was very muted. It was a tight range day. So we could actually get back inside the range and then break out of the top of the range. But we're going to continue to talk about being range bound for a moment. From our current low to yesterday's high would be considered all of our range argument. So if we stay within this box from 38.40 down to 37.60-ish, we kind of wicked out a little deeper there. But if we stay right there in that 80-point range, that would be our range argument for the day. Now, looking at it from this wide of a base, it's a little easier to believe that we could sustain that kind of a range today. 37.60 to 38.40. Within this range, we'd want to mark out all of our pivot points. So the close of yesterday's trading, the open of the RTH, the high of yesterday, the low from the Globex, every one of those would be pivot points worth marking out, because if we do go back up into those levels, they're the places that price is most likely going to respond or react at. The second argument would be that we continue this move to the downside. And for that argument or that consideration to the downside, we got to bring in a little more tape. And we're looking at 37.50, 3,700, and then 36.50. The NASDAQ and the ES both like those round numbers. Well, markets in general, right? They like round numbers, whole numbers. So that's not much of a surprise. And then back to the lows down here. Now we're already down 1.5%. We have an ADR of 2.6%. So we could easily make another 1% move to the downside, and it wouldn't even be considered an outsized move. A full ADR right now is 37.21. Half the ADR is 37.72, which we are already there and then some. So basically at this point, we want to ask the question, is it within our range to actually break to new lows? That would be a 1.6% move. That'd be over 3%, just a little beyond our current ADR. And if ADR is the norm, if ADR is what we've been doing on a day-to-day basis, we really do want to ask the question, what would an extreme move today be? And the way that I usually approach that is I take the ADR and I add another half of an ADR. From where we opened in the Globex to half of the ADR, I'm just going to take that. We'll set it at the full ADR, and that gives us some scope and some depth. That puts us at around 36.71. Now, if you're looking at that and you're thinking, maybe I'm reaching a little too much, that's a little too extreme, we can easily make that move. A 3.5% to a 4% move in this kind of environment is not off of the table. That wouldn't even trigger lock limits, right? So I'm not reaching too far. So we're talking about 36.75 in our extreme argument, should things get really nasty today. The third scenario is that we rally all the way up through yesterday's price action and we break out of the top. Seems like an unlikely argument, but I've said that before. Some of the best reversals that we've had in 2022 started with me doing a morning briefing where I say it's very unlikely, right? And then the thing that I said that was unlikely is the thing that happened that day. So we'll game it out anyways, and I'll continue to say the words that I'm about to say. It's unlikely that the third scenario is the one that we're going to see. But if we do come back up through yesterday's range, come out of the top, then we'll be focusing on 38.73 as half an ADR and 39.23 as a full ADR, which lines up really close with Tuesday's cash open. If we're talking about an extreme move, something beyond the ADR, then my target or focus would be to the high of these last 2 weeks, or at least the time frame that we're looking at here. And that would put us at 39.48. Right. So that's the three scenarios. Base case argument is that we just maintain between yesterday's cash session down here at 38.40 and through our own Globex this morning, maybe even getting a little bit lower because we're going to get some econ this morning and we're going to get a little bit of violence and whiplash. So maybe some wick a little lower, a little bit of violence, and then we just maintain this range down here. That's base case argument. Those base case arguments really are insightful, right? You got to have a primary purpose or a primary perspective, just like yesterday's perspective, right? The argument by 11 o'clock yesterday was that we were very likely not going to do anything else for the day, and that it was going to be that right there, from the RTH low and to the RTH high at that point in time, the rest of the day being base case argument that we were just going to stay there for the rest of the day. Of course, once you have that argument, you can also game out, well, what if we leave the range, right? Just like we do every morning. All right, so we're looking at a 10-day, 30-minute volume profile. We are back inside the box. We are underneath the point of control. We are right in the volume area. And if we happen to stay here for very much longer, we're going to end up moving this point of control down to that location. Now, it's not moved yet, but it's getting close. We spent the most amount of time where our current volume profile is. But as we get in closer to the open, if we spend a little bit more time here, we'll also have TPO move the point of control down to around 37.63-ish. If we break our own Globex low and start to get, say, below 37.58-ish, there's really nothing there to catch us. We're going to get into this very deep pocket here. I say deep pocket, say it another way, it's a shallow pocket. See how shallow the volume is, right? I've heard these called air pockets. I guess that's kind of another way to say it. Either way, there's no volume there, so there's no anticipated volume support, volume structure, nothing like that. Now, of course, we can always just reach left and mark out institutional pivot points, open, high, low, close from this Tuesday, Wednesday, and Thursday of that week and carry those forward. We could do that. How much validity they have, might come into question. But it would perhaps be better than nothing, right? Especially if you're making those moves with structure to the downside. And it has been a very orderly sell-off, right? We haven't had those kind of extremes consistently the way that we were getting them back in, say, February and March of 2020. We do have the point of control and the value area high and low of yesterday. There's always the argument that you could carry these forward into today's trading. I don't personally carry the value area high and low. Normally, I just carry the point of control. And if we've already tagged it, then I don't normally even do that. Now, the argument on this one, would we count it as being touched? There's a great argument that says maybe you shouldn't count it as being touched. If we had gone into the close that day already below the point of control, and then we moved away from the point of control and we carried it forward and we said, well, it's untouched, nobody would disagree with that. On the other hand, however, we closed where the point of control happened to be. And so, of course, as soon as we opened into the Globex, we were right there. But we never had a chance to not hit it, right? So, kind of the argument is that maybe you wouldn't consider it. Now, I don't make an argument on it one way or the other. You can count it, you cannot count it. There's plenty of books that's been covered on this subject. I don't think there's a winning argument on either side, but you do want to be consistent in how you do it. So if you count it, when you have this kind of situation where literally you open up in the Globex and you're already right there at the point of control, and then we move away from it, if you want to count that, then always count it. Or if you don't want to count it, then never count it, right? And just be consistent, you'll be fine. You don't want to get wishy-washy and jump back and forth. Maybe count it this time because it suits your needs, and then don't count it next time because it doesn't suit your needs. Okay. Been talking for a few days now about the dollar needing to stay below the 105 if we were going to see a sustained move to the upside in the S&P and the NASDAQ. Surprise, we're not above, or we're not below the 105 anymore. We got above it yesterday afternoon, dipped back down below it in the overnight hours, and we are now back above it and sustaining that move significantly, right? Consistent, persistent price action, one time framing, call it whatever you like. There is a clear message here. The only prints going opposite of the current market direction is very small amounts of profit taking. Every single trader, trading institution, trading firm, and algorithm are bid up in the dollar. Now, see, when you put it in that kind of terms, it really stands out, right? Kind of remove all of that ambiguity and wishy-washy and kind of sort of maybe terms and conditions. State it the way it is. We've got a bid up dollar this morning, and as long as it is holding and advancing above the 105, we should not be able to sustain any sort of a rally in the NASDAQ and in the S&P. So what you might want to be looking for today, if it looks like we're going to perform a bottoming maneuver and start rallying up above, say, the VWAP in the S&P, you're going to want to see that dollar sell off. At the very least, you're going to want to see the dollar begin consolidating, basing, setting a range, not continuing this advance. It looks like the VIX finally woke up. Somebody kicked it enough times that it got into the game, but not by very much. We're going to continue to not lean on the VIX. Generally speaking, in a market like this, the VIX and the dollar will begin to respond together. Think of the dollar as a global VIX at this point. The dollar's not always a global VIX, right? In the current market, in the current environment, it's our global risk gauge. Don't carry that forward forever because there's going to be a time when that's no longer true. But right now, if these two are responding together, then it's showing that the VIX is actually getting bid finally. I say finally because if you look at skew, it's been trash. We're at very low levels of skew, right? And this is because we're not seeing I'll say it another way. Why does skew exist, right? Well, skew exists because people fear the S&P going down, and that generally causes them to buy puts. And since puts are in demand and people buy them more than they buy calls, then puts are generally more expensive than calls. Thus, you have skew, right? And when skew is high, it shows that relationship very well. Calls are cheaper than puts. Puts are on demand because everybody fears a market going down. Basic, simple logic, right? And that's a very generic, cookie cutter, clean version of the argument, but it works. Kind of puts things in perspective. So when skew is really, really low, what is that implying? It's implying nobody's buying puts in the VIX. Now, whether that's just, a solid argument or not, you can go in and start looking at those values. And skew has more to it than that. I just gave you like the really generic base case. This is the VVIX. Think of this as an implied volatility indicator that you would apply to the VIX. The logic being, if you're looking at SPY, how volatile is SPY? Well, you bring up the IV, right? And you look at the IV. But when you're looking at the VIX, you can't bring up the IV on the VIX. The tool doesn't work like that. So how do we gauge how much volatility is in the VIX market at any one time? You use the VVIX. I'm not supposed to call it the implied volatility indicator of the VIX, right? If you were to say that to somebody else, they would look at you like you are crazy. So I'm saying it, but I'm taking it out of context because it's the easiest way for me to explain what we're looking at. Notice how low it is. We're in a very violent environment right now. Wouldn't you believe that the VIX would have a high volatility right now, considering we're in these lows and we're in these extremes? And where's the fear? Where's the hand wringing and the angst and the pain and everybody just, there isn't any. We're at really low levels in the skew or in the volatility. The amount of volatility within the volatility index is very, very low. This affects options pricing drastically. Keep your eye on the dollar. We want to see that dollar get back below the 105 today. We want to see that it's going to stop advancing at the very least, begin basing or consolidating, and or drop back down below that 105. At the same time, we want to see the VIX do the same as the dollar, uh, not advance, calm down, relax, maybe drop back down below that $29 level. Energy has been front and center in a lot of articles in the last few days, including uh, issues with actually being able to keep the power on, right? So a little bit of an energy crisis. Um, Directly connected to that is the nation's reserve of energy product, whether that's oil, gasoline, you name it, right? The nation keeps this reserve, and that reserve is getting dangerously low. I have a chart for how low it is. Of course, I'm looking for it. It's when I can't find it. All right. I will put it in the chat of the stocks and options channel in the Discord. for those of you on the YouTube that aren't in there, well, one, why don't you come join the Discord? But two, this is what I'm referring to. U.S. Strategic Petroleum Reserves. Blah, blah. I got it out there. Dangerously low. On top of everything else, right? So keep your eye on energy. We've been saying that. It's still true. Nothing's changed. Keep your eye on it. When you see oil making significant breaking moves, maybe tighten your stops, start looking for the impact of that move on the rest of the market. You can see that we're yet again bid up this morning in the bonds. It's kind of nice to see. Bonds are actually acting like bonds. Yeah, nice. So we want to see today, if we're going to look for that break to the upside, we should see it in the Russell, the NASDAQ, the S&P, maybe even see it in Bitcoin. There was another really big hack, so we may not see it move in Bitcoin. It's hard to say when you have that kind of news behind it. So not quite sure on the Bitcoin one, but generally speaking, we should see it, right? It certainly responded when the rest of the market responded last night during the kill zone between 2 and 4. Maybe at the very least, a little bit of linear regression and some mean reversion would bring it back towards the upside, right? And remember, you can now trade a nano version of Bitcoin futures using BIT. It's like 5 cents for every tick. So it's super, super tiny, tiny futures product. We talked about it a little bit yesterday. All right. Almost every single sector, yeah, surprise, is in the red. There isn't any, Josh. There is absolutely nothing pointing to an upside move. Absolutely nothing. Maybe you just showed up late and missed the entire part where I said there's nothing, right? But every single day, we game out the 3 scenarios because the market can only do one of 3 things, right? It can hold the base, it can hold the range, it can move up from there, or it could move down from here. And that's what you must have missed, is all of that. But don't worry, we'll do it again tomorrow. We'll do it again Monday, and well, not Monday because it's a holiday, but it's what we do every day. Every day, every morning, we game it out because there really is only those 3 situations. The only argument that I do have for an upside move today, and it's not a very good argument, is linear regression, mean reversion, least squared methods. That's the only argument that we have, and that's not a very good one. Oh, and a crap load of econ this morning. There is that too. But other than that, there's not one thing on the chart this morning that says upside move. Bitcoin is the most extreme down. Looking at our sector list, even the precious metals and emerging markets, we use emerging markets for kind of a global risk on, risk off gauge. USO, I mean, literally everything in the list, right? Retail, utilities, healthcare. The only thing that isn't down this morning are the bonds, TLT. IYW is up slightly, but it needs to be up at least a 0.5%. And on this one, if it hasn't gotten a print this morning and it's still using the print from last night, then it's not technically up, right? Because this will read after hours and pre-market, but it won't tell you if the number is reflecting from after hours last night or from the pre-market this morning. So the ones that are flat, we don't really lean into those at all, not even a little bit. My benchmark is at least a 0.5%. It needs to be down a half or up a half before we start to make the argument that it's up or down in the pre-market. These legacy sectors, the 11 legacy sectors of the S&P, they don't really do much justice to the modern world that we live in. So we tend to break that down. Just look at something like the crypto, right? And inside of that, looking for anything in there? Nope, not really, right? We got BITI, which is the short crypto, that new product that they just came out with. And one name on the list, but that's it. The rest of them are down. We got our EV names. Li Auto's got a little bit of a bid, it looks like. Otherwise, even our legacy names like GM and Ford are down this morning. This shouldn't be a surprise to anybody, right? I mean, it's exactly what we would expect on a morning like this. A highly correlated coefficient. Now, generally speaking, we need one of the three sectors if we're going to see a rally. But what we really want to watch for this morning when we're talking about that highly correlated coefficient, if you look at the top of your Thinkorswim, consider these menus and submenus, right? So this would be your first menu your first menu group. This would be your second menu group, and then this would be your third menu group. So you want to go to Market Watch, visualize, get rid of that heat map, flip it over to an index. This is where you get to pick the index, set it to the S&P 100, set it to the NASDAQ 100. These are detachable, so you can actually open up like the NYSE, the Russell, your own watch list, build it out, have 5 or 6 of those things floating around. But what you want to watch for through the morning is the correlated coefficient, right? How correlated do we get? An extremely correlated market becomes very dangerous. It's where some of the biggest moves in history have ever come from. Issues are companies. There's 100 names in the S&P 100. What we want to be watching for here is how many issues, how many companies are moving up versus how many are moving down, and how much capital is coming in versus going out. If there's going to be a move to the upside, it very often starts to show up in here first. You'll at least start to see divergence, because if you have candles going down and then you have more issues going up than down and more capital going in than out, then we start looking for the knife catch, right? The flip off of the lows and the rally up. If on the other hand, because we are gapped down, if we see those green candles when we come into the open, the way we would expect to see green candles when we come into the open on a gapped down morning, if we're getting those green candles and yet we're still showing more issues going down than up and more money going out than in, that's your bearish divergence, right? We would know that, or we would suspect that that green candle that we're seeing at the open is nothing more than an attempt to close the gap, and that we're still bearish, that the money flow is still bearish, that the market is still bearish, and that we're still going to be looking for the flip and the continued move to the downside. Highly correlated market state. We did build the alpha protocols with this in mind. Now, generally, we talk about them from the call side, but they work just as good on the put side. And that is that we trade like the algos would trade. Build your own little basket of stocks, highly liquid option names with high beta. And if we get a 97, 98, 99% coefficient that you buy every name on the list, in this case, it would be buying puts between, say, a 45 and a 55 delta. Now, that's my protocols. You could easily back that off to, say, a 40 and a 50, right? Somewhere between that range of your deltas. For any name that doesn't immediately respond with the market conditions, cut that name off of the list. Don't wait to see how if it catches up later on, or maybe it's just slow to the uptake. It's not worth it. We're talking about trading into 10 or 15, 20 names all at once. Don't screw around with one name that isn't participating the way it should. Cut it, get it out of the list, and let the rest do their job. We don't often get a chance to run the alpha protocols, but considering the kind of morning that we're looking at today, we may actually get that opportunity, right? And it's not something that we would want to do all the time. So it doesn't bother me that we don't get the opportunity all the time. So definitely be aware of the correlated market state potential today, especially when we're sitting there looking at every single name on our list, mostly, and every sector on our list, all doing the same thing. So what I got for you guys, be careful, be safe. I will see you all tomorrow.